morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. You're watching Indian Open and I'm Neeraj Shah. Good morning, Ira.
Good morning, Neeraj, and a very good morning to all of our viewers. Let's get you the headlines this Wednesday morning. Asian markets recover some of the losses from the last couple of days as US equities rally. All 33 economists polled by Bloomberg News expect the Monetary Policy Committee to stay put on interest rates today. Asset reconstruction company driven by SSG Capital buys 2,500 crore worth of Bhushan Steel loans from two public sector lenders. And we're watching out today for earnings from Aurobindo Pharma, Cipla and Eicher Motors.
Well, and clutch of, yes, it will be an earnings heavy day for sure on the Nifty as well as the broader end of the spectrum as well. Let's see if earnings are allowed to take center stage or whether the market performance takes that. Though, if you frankly look at the headline numbers yesterday, you would think that it was just another ordinary day. And what happened was that the indices bounced off the 100-day moving average. But of course, we all know the hidden story behind it. It was essentially the Dow futures and the manic moves that they had all through the Indian trading hours yesterday, which led to the markets gyrating big time in trade, ending up about 1.5%, ending about 1.5% lower as compared to the 3.5% that they started off with, essentially because of the Dow futures pullback as well. Interestingly, both for the Nifty and the Bank Nifty OI, we heard a bunch of traders say yesterday that they will not take any kind of short positions, 3.5% down. So I guess not too many short positions taken. Some bit of unwinding that happened within almost for both of these key indices as well as some of the others too. The interesting bit though is that from a trading perspective, the maximum OI for the Feb series shifted to the 10,000 put from the 10,500 strike earlier, clearly showing that traders are now hedging their bets in a big way. That saw a big build-up. Their 10,000 OI put strike went up almost 28%. At least shows the sentiment in the market currently. The last 2 days, the one interesting thing that's happened and a bit of a change from what used to happen in January is that FIs have been sellers. Both the days, the provisional numbers of the FIs have been northwards of 1,000 crores. Yesterday, about 2,300 crores. I think in 2 days, provisional numbers. Provisionally, they sold about 3,500 crores already in the last couple of trading sessions. So FIs continue to be heavy sellers in the markets. You could probably look at all those charts and try and figure out which way the index is going to go. I think it's just a difficult call to make currently. The SGX Nifty clearly indicating that we'll start off about 100, 125 points lower, higher, but that anyways just takes off the kind of cuts that we had yesterday. It's very, very difficult, I would presume, to figure out whether we are back in an uptrend or whether this will continue to go down. Let's focus on a couple of stocks, aside of Hero MotoCorp, of course, and we'll talk about that in great detail a bit later on in the show. Some among other stocks to watch. I've just chosen some results out here. I thought KEC International, the order wins and the results, more importantly, fairly strong set of numbers came in during post-market hours. Should be interesting to see what this one does. Extremely strong numbers. I've chosen 3 strong numbers. It's a day in the green. Watch out for Gandhi Special Tubes, Gujarat Alkalis and Shanti Gears. So auto components have been in the thick of things. Let's see if Shanti Gears has some momentum to it in today's session. And I thought one exceptional set of numbers was Ramco Industries. Revenues up, EBITDA margins doubled, net profit almost 140% higher. It's a tiny tune, but Ramco Industries, after facing some brunt of selling pressure yesterday, could see some bit of revival. Last but not the least, Dish TV could be an interesting one as well. The numbers okay, but they're going ahead with the Videocon merger. Should be interesting to see how the market receives it. Last but not the least, Ida, as I said, almost everybody would have their own thoughts, but I thought Lawrence Belanco's thought was interesting. He says for India specifically, with the correction and the overshoot with the 200 moving averages possible, which is what something a lot of technical traders look at, he's saying that the current correction should be used as a buying opportunity. The upside target, according to him, 12,000 area.
So maybe we are seeing some intermittent episodes, if you want to call it that, but some people continue to believe that we are in a bull run. It's divided right down the middle, to be honest. The extent of the cut before the slide resumes upwards, but yeah, some fairly bullish calls coming in by certain people as well. Right. Let's try and get some views as well on what's been happening in global markets to understand what veterans are making of this volatility that seems to have returned. Anil Ahuja, Chief Investment Officer at IPEplus and Asia Staff Funds, joining us from Singapore. We'll also try and connect to Arvind Sanger from New York. Anil, good morning. Thanks so much for joining us here early this morning. Basic question: what have you made of the last few days? Various reasons attached to it, but at the core of it, it seems like it's a return to volatility, which some people would argue is normal.
I think it started with the. Sorry, is this echoing or is the voice clear?
Clear to us, Anil, if you can hear us well.
Yeah, I can hear you clear. Okay, thanks. Sorry. No, it started with the Treasury move going up to 2.8%, and I think that drives a lot of behavior, and that sort of suddenly cemented the risk of 3 to 4 rate hikes for this year, which fundamentally should be negative for equities. The moment that started, I think somewhere along the line, the momentum of selling picked up, and I don't know whether it was automated trading or not, but something obviously triggered that last drop on Monday evening, which was crazy. And what would have been a normal sort of correction or a mild pullback suddenly became accelerated, and things took a life of their own. But if you look at the backdrop is very sensible on the global side. The backdrop is of a synchronized recovery. You're looking at earnings improvement. You're looking at the central banks not doing anything in a knee-jerk way, which could result in a market collapsing or crashing or anything like that. So I think that the central banks working towards controlling volatility, managing the rates. So I was surprised that the reaction was as strong as it was. I think the volatility is clearly 10 is probably not normal, but neither is 50.
Let me try and connect with Arvind Sanger. I think we just got Anil Ahuja on a slightly patchy line, but I believe Arvind Sanger can hear us. He's managing partner at Geosphere Capital Management, joins us. Arvind, good evening to you out there, and thanks so much for joining in. Well, you are in the epicenter of action, if I may call it that. What have you made of this recent volatility? Automated trades or nervous fingers, or just another blip in an otherwise strong market?
Well, I mean, I think the correction was probably overdue. The market had gone almost vertical in the last few weeks. And, yes, the tax bill passed was bullish. Yes, economic growth is looking better. But I think what brought the market down to earth was sudden realization after some of the payroll numbers on Friday that maybe, inflation might be back in contention. And if inflation is back in contention, then is Fed going to have to be a little more aggressive on rate increases? And I think, it just caused a little bit of fear to come back into the market. And, in a long-term bull market, you can't have everybody in ultimate euphoria and VIX at record low levels and everything goes up forever. That just is not, is not normal. So I think it's a healthy overdue correction. I think it causes reassessment of risk. It causes reassessment of interest rates and valuations, and all of those are I think overdue. Again, I think that global growth is getting better, and that's the positive. Interest rates are going up. That's the slight negative, but I don't think it's enough to derail growth. So we still remain constructive, but we remain cognizant of the fact that valuations had gotten way ahead of fundamentals, and so this kind of correction gives us an opportunity to get back in on companies that we think valuation has gotten more reasonable now.
So, but Arvind, is this 5 to 6 to 7% correction? Is that about it? I mean, you can argue that in points terminology, yes, the corrections are fairly deep, but 4-5% is par for the course. You've seen corrections like these happen in one single day. Is this the quantum of drawdown that everybody was talking about and hoping for?
Well, no, I would say that clearly, one can't assume that the correction is done and dusted, and that, the two-day correction took care of all the problems. So yes, there was a rebound today, but I think there might be some volatility, and that might cause a little bit more opportunities. Yeah, frankly, the reality.
Would you be bracing for more, Arvind? I mean, my question simply is, that's something that I've been trying to ask everybody. That the one answer is that there is a drawdown. Let's put out some money out to work because stocks are at the levels that we wanted to buy. Sure, the mid cap and the small cap, and in India at least, has come off quite a bit. The question mark only is, can this only deepen? And you as a fund manager, are you bracing yourself for some more dips, or do you believe this 4, 5, 7% on the large caps and 10, 12, 15% on the mid caps and small caps is about the damage that you would have thought there would come about?
No, I think we're prepared for more. So we are not putting all our chips on the table. We're putting some of our chips on the table. and taking advantage of, like you said, pullback in the mid caps has been much more dramatic, and there have been some places where the stocks have reached our target price, so where we'd like to buy them. So we're selectively buying where we're finding those kind of opportunities. But in the broader market, can we declare, all clear siren and come out of our foxholes and say everything is fixed? No. But I think that the reality is, if we take the view of long-term investors, unless we see something that suggests that growth is about to get derailed or something else is going to happen, I don't think we can live in too much fear. We have to be circumspect on timing and valuation and finding good stocks at right prices. But at the same time, we don't see anything that has happened in the last few days suggesting that the bull market is over, anything that is creating that risk. So yes, there's going to be volatility, and we may not have seen the bottom, but I think we've seen the sharpness of the sell-off, the big sharp sell-off behind us, and anything that happens from here will be somewhat less sharp in our opinion. But let's wait and see.
Yeah, let's wait and see. Last question, Anil, to you. We have the RBI policy today. So from an Indian perspective, we'll have a central bank which arguably will sound, presumably will sound more hawkish than thought otherwise. Now, what happens here now? The yields have already moved up in India for maybe different reasons as well, but the yields have already moved up. Now the reserve banks will play a bit of a catch-up in the commentary and an action over the course of the next 6 odd months. Does the market get spooked by that as well?
No, I think the market is not expecting any rate cut or any dovish commentary from the RBI, at least not today, especially in light of the budget and, various, I wouldn't call them SOPs.
No, Anil, I was asking if the commentary is hawkish, because the market expects the commentary to be hawkish. So if the commentary is hawkish, and if there are some rate increases over the course of the year, have the markets already priced that in, or will the markets get spooked by that?
If there is a rate increase, they will definitely get spooked, but I don't think there will be a rate increase by the RBI, because I think that will fly in the face of politics. And I mean, I recognize that they are independent, but I don't think they're completely divorced from market expectations or reality either.
Okay. Now, I was actually meaning to ask if there is a set of rate increases over the course of the year, not really today. Today, at best, I would believe, or at worst, they'll sound hawkish.
No, I don't think there will be.
Yeah, please carry on.
I don't think there will be a rate increase in the near future.
Okay, fair call. Anil, Ahuja, Arvind Sanger, gentlemen, thank you so much for taking this time out and giving us your thoughts. Well, that's the take from two market experts on what to expect. Arvind Sanger clearly believing that the sharp falls are behind us.
As Neeraj has reminded you several times through the morning, it is policy day today. The Monetary Policy Committee will be deciding on rates. Ira standing by to tell you what could be influencing the committee's decisions today. And we'll also talk about corporate tax. Now, will lower corporate taxes for companies with a turnover of up to 250 crore rupees actually help create more jobs? As the finance minister had said in his budget speech, that's one thing that we're also looking at this morning. But of course, the more important issue is of rates today. And Neera, what are you expecting?
Well, let me get into place there. All right. So, I think there's no expectation in terms of a change in rates. Some people would say headline-wise it may be a bit of a non-event policy, but it probably won't be. Post-budget policies are always interesting to see what they make of the government stance. And in this year in particular, there are a couple of uncertainties. Last couple of years, the budget didn't throw any left out of the left field kind of situations at the MPC. This time around, there have been some. Let me just give you the full setup. Inflation has been on the rise. Don't need to dwell too much on it. We're at about 5.22% in December. But remember, the inflation targeting framework as a forward-looking framework is more worried about what lies in terms of inflation ahead. So you've got an expectation that inflation would range somewhere between 4 to 5%, 4 to 4.5% in the first quarter of the new fiscal, and then move back a little bit. That is the inflation scenario as of now. But remember, between last policy and this policy, you've already seen seen oil prices continuing to rise, about 10% rise between the two policies. Overall commodity prices are up about 5% if you look at the Bloomberg Commodities Index. So there is already upside risk to the inflation scenario, and that had been pointed out by both Urjit Patel and Viral Acharya in the policy last time around. Now you bring in the budget and you see what the budget has done. The first thing that the budget has done is bring in uncertainty on the fiscal consolidation path. You've got a 3% fiscal deficit now being targeted at FY21. I keep reminding people that Urjit Patel was the author of the Monetary Policy Framework Report of 2014, and in that report he had talked about the fact that a 3% fiscal deficit target is necessary and achievable if you want to move ahead with an inflation target of 4% plus minus 2%. Does Urjit Patel take a different stance now that the government is trying to curb expenditure and the slippage has come from the revenue side? We'll wait and see. The MSP story, there's no consensus on whether the MSP commitment of 1.5 times production cost for the Kharif season is going to be inflationary. Bank of America Merrill Lynch says no. Credit Suisse also seem to feel that the inflation risks are overdone, but there are others who are still waiting to see how it plays out. Nomura said that there is a certain amount of automatic increase that comes in the headline inflation number for every percentage increase in MSP, and JP Morgan said that paddy is where the story will play out, because the paddy MSP is at about 39% of production cost right now, and if that has to go up to 50%, you could see a significant increase in the headline inflation rate. So those are the macro aspects. In terms of markets, I actually think this is a far more important policy for markets than for anybody else. You know that the markets are nervous. You've seen the 10-year bond yield rally, 150 basis points above repo. I've been saying this for days on end. But should the RBI take note of this? And here I'm saying RBI as opposed to MPC, because inflation, liquidity measures are more the purview of the Reserve Bank of India. Last policy, when Urjit Patel was asked that bond yields are rising, why is the RBI maintaining such tight liquidity conditions? He almost snapped back to say that please look at the call money markets, and the rate there is at 6% near the repo rate, so there is no liquidity shortage. So if that is the kind of stance he maintains, while there may be some calming noises for the bond markets, maybe there won't be any real support in terms of an indication that more open market operations would be conducted. And then in all of this, the last factor is what we've seen in the global markets over the last 2 or 3 days, actually 2 or 3 weeks, as US yields have risen. So they will keep that at the back of their minds. But, they can do precious little about it, except, of course, be cautious of any dramatic or sudden rate moves back home here. So that's the overall setup, guys.
Okay. I mean, that's it, right? Okay. All right. We're going to talk a lot more about monetary policy expectations. That's a little later this morning with Ashish Parathasarthy of HDFC Bank and Manish Wadhawan of HSBC India. So you'll be able to tune in on to what the broader set of expectations is on this policy. But I think Ira's laid it all out in great detail, and there's really not much to debate here. That's what the policy is going to look like this morning. Now, for a brief few minutes, we're going to segue away from markets and policy and look at something that was the outcome of not just this year's budget, but this government's budget-making exercise for the last 4 years, right? So in this year's budget, 99% of all companies in the country got a tax break. Finance Minister Arun Jaitley announced that companies with an annual revenue of up to 250 crore rupees will now be taxed at 25% versus the earlier 30%. Of course, cess and surcharge makes that a higher effective rate. But anyways, Mr. Jaitley said, and I quote, the lower corporate income tax rate for 99% of the companies will leave them with higher investable surplus, which in turn will create more jobs. So the question we're posing this morning is, how effective will that tax cut prove to be? And we've done some very rough calculations to sort of try and understand what it amounts to, right? So in the budget speech, first, okay, before I get to the budget speech, take a look at what corporate tax collections are or have been. FY18, the number is about 5,63,745. FY19, 6,21,000. Those are the corporate tax collections on an annual basis. The amount that the government is giving away by its own admission on account of this lower rate is just 7,000 crores. So that in itself should tell you first that it's a really small amount in the larger context of things. Okay. Now, what did the finance minister say? He said 7 lakh companies, of which only 7,000 now will be paying the full rate, which is 30%, right? I've just rounded that off to say, okay, 10,000. So which means 6,90,000 companies will be paying 25%. Okay, that's the basic assumption here. Effectively, if you divide up or divvy up 7,000 crores across 6,90,000 companies, that works out to roughly, a benefit of about 1 lakh rupees per company, okay? But that might not be the right way to look at it, because not all of these 6.9 lakh companies actually make profits and therefore have to pay tax. By the government's own assessment over the last 4 or 5 years, if you look at the revenue foregone data, it suggests that about 44% of companies actually, don't pay any tax whatsoever, either because they don't make any profits or they make nil profits. So if you were to reduce that 6.9 lakh number into, the total number of actual potentially tax-paying companies, it roughly works out to about 3,17,000 companies. And therefore, the saving per company then increases to about 2 lakh rupees, 20,000. Now, you can argue, what does that mean per firm? If in a year, on account of this tax cut, you are saving 2 lakh rupees, does it go anywhere towards fulfilling the finance minister's, claim or statement that this will help them create more jobs? Maybe this is too simplistic a calculation for some economists. Of course, some companies earn more revenue than others, therefore their saving will be more than others. This is an averaging out. So, all that criticism is welcome, but this is broadly what it works out to per company, right? So it does not amount to much, definitely not, will not go in any big way towards generating jobs in this economy, might give some relief to smaller companies. I'm going to end with 2 points here. One of the most noteworthy things about this government's tax policy starting the year 2015 was the fact that there was the first time a finance minister in this country stood up and said, hey, look, our corporate tax regime is way too complicated, and we need to simplify this because on the one hand, the statutory tax rate, along with the cess and surcharge, is very high. It's 30% plus cess and surcharge, which roughly works out about 34% or so. But on the other hand, we have this slew of complex exemptions and deductions, as a result of which we don't really get much tax, right? So we want to clean all of this up, and we're going to clean it up over the next 4 years. So I propose to do away with all the exemptions and deductions, and I propose to reduce the rate from 30% to 25%. One might say that he had went some way towards fulfilling that when last year he did that for those companies that did annual turnover up to 50 crores. This year he did it for up to 250 crores. But as you can see, the smaller universe of companies that actually pay the mammoth amount of tax, has been unimpacted by this whatsoever. They've got absolutely no relief. I would argue that those are the companies that actually are able to generate jobs on a large basis, because they will actually see a big impact if their tax rates go down. And for anybody who's arguing in this country that tax rates are 22 or 23%, and we've heard over the last 3-4 days, many people from the tax department or even from the finance ministry argue this when trying to defend why they did not make these cuts extendable to large companies. Just take a look at the effective tax rate. According to the government's own data, this is the data that comes in every budget document when you look at the revenue foregone. In FY14, if you looked at the tax rate without dividend distribution tax, it was 23.22%. If you added dividend distribution tax, the effective tax rate was 25%. It went all the way up to 31% in FY16. That's the effective tax rate. Exemptions, everything included. The effective tax rate by the government's own calculation is 31.33%. In FY17, it's come down a little bit to 29.69%. So it's definitely not 22 or 23%, as some people have been saying in commentary otherwise. This is the effective tax rate according to the government's own data. And it's definitely not low by any chance, right? So I think the argument I was trying to make here is, great that 99% of the companies have got the tax break that you promised in 2015. But is that really enough to accomplish what you promised you wanted to do, which was very, very notable, which is simplify the entire system? Last, we heard the finance minister say in a FICCI gathering that, by the way, till all the deductions and exemptions don't go away, it's not possible for us to give you this tax cut. That's really difficult, because some SEC deductions and exemptions will take several years to go away. Other deductions started falling off last year, and so they have gone away, but not every deduction has gone away. So I don't think that all the deductions will go away by next year. We're still trying to collate data on that. But that means that is he effectively ruling out a tax cut for large companies next year as well? Now, there's only one reason for why they're not able to do this. I'm sure they want to fulfill their promise. But I think a tax cut to large companies, the CBDT chairman told us, would have cost them 60,000 crore rupees. As IRA has reminded us so many times, the government just doesn't have the money. So they don't have the money, but they should have planned this because they made the promise in 2015 and it was a notable promise. And it's very unfortunate that the one highlight of this government's fiscal policy, which was smarter taxation, in some sense has been undermined by their own inability to allocate money to it.
Okay, so a couple of questions. Sorry.
No, please.
No, so the effective tax rate here, how does it compare to, say, other economies? I heard a lot of commentary going to the budget that, now that the US has cut, even at the 25% for the SMEs, how do we compare globally?
So US is down to 21%, so they say.
Across the board, all sizes of companies.
Apparently, yes. But again, everybody's still studying that voluminous US tax reform bill or whatever act and trying to figure out what it means for which set of companies and how. The numbers are varying. Before the budget, if you remember when we discussed the potential of a corporate tax rate cut, some private consulting firms put the effective tax rate in India at 40%. I don't know what exactly they are calculating. They're including DDT in this, but they claimed, and I think I don't know if we can pull that chart up, but it was from a few days ago. They claimed that India led the pack. When you added DDT into the corporate tax rate, it led the pack and was ahead of the US as well at an average about 40%. The government's data suggests 29.69%. Different people have different ways of calculating and how they're calculating this, but we are amongst the higher taxed countries, And I'm not even suggesting that companies should get a break. I'm just saying the principal philosophy of what Mr. Jaitley announced in 2015 was very good. That let's reduce the complications in the system and create a lower effective tax rate, but no exemptions, deductions, because those allow you to game the system. Unfortunately, then yesterday we had the CBDT chairman say, oh, but if half the companies in this country are not paying tax. I think the CBDT chairman or one of the officials in the finance ministry, if half the companies in this country are not paying tax, how can corporate India expect a tax cut? But you knew this all along. For the last 10 years, only half the companies, only 44 or 45% of the companies, have been in this country have been paying tax or close to 50%. So it isn't like any of this is new data. You knew this when you made the promise. Clearly, you would have calculated all of this when you made the promise. Yeah. The promise was noteworthy. If only you had allocated enough funds towards that. But I suppose somewhere, the last point here. This fiscal policy angle was the one thing that characterized this government as right of center. I mean, nothing in budget so far has done that, right? In 2015, when Arun Jaitley stood up and said this, that was more right of center than anything else from an economic policy point of view. A cleaner, lower tax regime, which encourages more compliance, easier to manage. And to his credit, I think the tax terrorism that we heard of in the previous regime has in some ways dissipated now. Yeah, I know there are startups suffering and all of that, and there are small pockets, but the large noise has gone away. And yet, this was the one thing they could have fulfilled, but unfortunately, they just haven't been able to, which is really sad because it was a great promise.
No, I just have one small question before we wrap this up. You mentioned that there are two things that they haven't managed to do, which is one is simplify the tax and two, bring the tax system and two, bring the tax down, right? The promise of 2015. My question is, it's a high tax regime. Is it more complex than what it was in 2014?
No, it isn't. Why would it be more complex? Simplify meant taking away the various. So we get, for instance, a couple of the biggest deductions. One is SEC, where you get a large amount of profit deduction. The other is accelerated depreciation, which allows you to claim a large deduction on profits, right? So I think those are just two. And then you've got things like for power companies, there was something. For telecom infrastructure, there was something else. So we had a very unwieldy set of exemptions, deductions that were created over decades to try and encourage small, this industry needs help, so let's give it this. This company needs help, so let's give it this. Now, the goal was to clean all of this out, right? And not have any of this exist, with the exception of maybe one, generic exemption or something like that. Like SECs would survive for a little bit of time, but even they would fall off. So that was the goal. The cleaning up has started. Many of these taxes started falling off as of last year itself. The depreciation, accelerated depreciation has also been capped as of last year, I think at 40% from what I understand. But, the full cleaning up was going to always take time because when you get those exemptions, you get it for a period of time, and we just hope that, the tax rate cut would follow alongside. Next year is the last year. It's a vote on account budget.
Yeah, so now it's down to the next term if there is one. For
I don't know if they are going to look. If you had 60,000 crores to spare, would you give it to large companies next year, or would you give it to some?
Not next year for sure.
Not next year, right? I mean, you're going to do something that helps you, sort of come back to power.
Yeah.
So this was the year where they could have done it. Unfortunately, I don't think it's happened. So it'll become one of those promises saying, "Hey, bring us back to power, and we'll do this." But Anyways, so much tax conversation for early in the morning, but that's that.
No, we'll have market conversation on the other side of this break now. Remember, the Asian markets are doing very well. So that's it. This is the end of first word, but full tilt towards the day trade on the other side. Stay tuned.
आइसक्रीम ये है डबल आनंद। पहला आनंद पॉलिसी टर्म के अंत पर मैच्योरिटी क्लेम का पूरा भुगतान और दूसरा आपके अपनों के लिए लाइफ कवर की पूरी रकम बिना किसी प्रीमियम के। LIC न्यू जीवन आनंद, आनंद ही आनंद।
RP Sanjeev Goenka Group, growing legacies.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're watching Indian Open on Bloomberg Quint. My name is Neeraj Shah, and let's take a look at what the Asian markets are doing at this hour. A fair bit of green on the screen. The SGX Nifty about 1% higher, off from the levels that it was trading at. At point of time, the SGX was indicating an uptick of 143 odd points. Now about 107 odd points, still in the green. Just a quick check on the derivative space. Let's start off with getting in Navneet Saluja, who's standing by with the FNO setup for the morning. Good morning, Navneet.
Good morning, Neeraj. Well, after yesterday's volatility, there could be some respite for the markets today, as SGX Nifty is suggesting. So if you look at the Nifty futures yesterday, there was no fresh short build up because the open interest once again fell by about 1%. Pull up the Bank Nifty futures, which were pretty volatile, especially in the last half an hour of trade. You would have expected that there would be some fresh positions being taken ahead of the monetary policy today, but that was not the case. It was more of intraday trading which was taking place. So for the Bank Nifty futures as well, open interest fell nearly 2%. Well, the focus for this market has been on the volatility index. Remember, it rose as much as 44% in yesterday's session, and after rising to those levels, it settled with gains of 25% around the mark of 20. Well, higher WIX still remains one of the key concerns for this market. Let's tell you what the put-call ratio was yesterday. Some respite because the Nifty PCR rose to levels of 1.13, and even for the Bank Nifty PCR, we did see the levels going up. Let's tell you why the PCR went up. We'll just pull up the option strikes for you and tell you where the maximum action was there in yesterday's session. Remember, in the put side, now the maximum OI has been shifted to 10,000 put from 10,500, which was there in yesterday's session. The red bars are your put strikes. So yesterday, when the markets were down, clearly the put writers were running for cover. So you had strikes like 10,600, 10,500, as well as the 10,700 strike, which saw maximum unwinding. But there was call writing seen around the mark of 10,500 call. Even the 10,300 call in and yesterday's session was pretty active. What did the institutions do then in a volatile market like yesterday's? Well, they've been unwinding their long positions, at least on the index futures. I'm talking about the FIs, but the short positions have been going up, and yesterday as well, almost 18,000 contracts were added. And look at this number. We started the series with 80% net long, and that number has come down to almost 58%. Well, we'll pull up the options data for you, and the picture is there. They've been buying a lot of protection, and this is just not yesterday. In fact, in the last 2 to 3 sessions, I've been observing that the FIs have been buying a lot of put long. So yesterday, 50,000 contracts were added, and even on the call short side, there was some writing seen there. Well, in terms of stock futures, which stocks to keep an eye on in today's session? Well, one stock which is entered into the F&O band once again is Gen Irrigation. Remember, we highlighted this for you in the closing session yesterday. So Gen Irrigation was down almost 6% yesterday, and that's the new one in the F&O band. There are 2 stocks which have come out. One of them is India Cements, and you've also got Walk Hard, which is out of the F&O band. So do watch out for all these counters in today's trade. But lastly, also watch out for Mindtree. That was a stock which was quite active in a weak market like yesterday's. There was good long build-up, seen 17% higher open interest in yesterday's trade. Let's see if the momentum for Mindtree can continue in today's trade, Neeraj.
We'll watch out for all of these. Yes, interesting stocks out there, a couple of which we highlighted in closing hours yesterday as well. Let's get in a thought from Abhijit Phatak, Director at Definite Solutions, who joins us on the show. Abhijit, good morning. Thanks for joining in. How are you approaching trade today, Abhijit?
Good morning, Neeraj. Yesterday, Nifty took support at a very crucial level. The 10,276 low on the spot was very crucial. I had mentioned yesterday 10,250, 10,270, and that acted. And I might be a bit bold in saying we might resume the uptrend, which which took a break over the last 10 days. So, and of course, it's difficult to use that as a stop loss, but any dip should be used to buy and go long. And I wouldn't be surprised if we go back towards 11,000 in the coming days.
Wow. So, are you taking long positions via futures or via options, Abhijit?
It will be better if it is options, because global markets are still, people are still in the shock, so it can be a bit risky. So 10,800 call, maybe if it comes down near 50, 55 or 60, that can be a good bet and carry it for the next few days.
Okay, so you would buy it only if it comes on those dip, right, Abhijit? You will not go out and buy it on open today.
Open, it's a bit difficult because it depends. If what SGX Nifty indicates happens, then it will open maybe above 80, and that will be because the stop loss is below 40. If for anyone the risk is okay, buying above 80 with a stop loss of 40, it can be bought, but there might be a dip intraday because the RBI policy is also there. So maybe half quantity can be bought and half on the dip.
Okay, and Abhijit, what about specific stocks? Yesterday, I think you were shying away from taking calls, maybe for the right reasons. In today's session, is there a stock-specific recommendation that you have?
To be honest, so many stocks are looking good, so it's really difficult to select. But yesterday, Bharati, in fact, yesterday as well as the day before, in the weak market, Bharati showed a good upsurge from the lows, and that is looking bullish to me. With a one can buy near 435 with a stop loss of 430, and it can go towards 445 or even 454. In fact, I expect Bharati to go towards 470, 475 in this month.
Abhijit, my final question to you really, on a stock, not necessarily from an F&O perspective, but maybe from a charts perspective. 2 days on a trot, Jamna Auto from the mid-cap auto ancillary space has shown some rapid momentum. Yesterday, Navneet pointed it out as well, ending at about 80. It's recouped almost all of the losses. What does one do here?
I'm sorry, I don't track it and I don't have the chart open, so I'll need 2 minutes, which we don't have right now.
No, which is fair, Abhijit. We'll try and take that question with somebody else. But thank you so much for giving us these thoughts. And Abhijit, a good conviction yesterday. I'm glad it's worked out well for you. Thanks for joining in today.
Thank you.
That's Abhijit Phatak with his thoughts on what to do from a trade perspective. Well, let's get in. G. Chokkalingam, founder and managing director at Economics Research and Advisory, joins us on the show from a fundamental perspective as well. Mr. Chokkalingam, thanks so much for joining in. Are you in the buy mode currently, or are you taking a pause? That is one. I'm just coupling it up with one key number that came out as well yesterday, Mr. Chokkalingam, because you tend to look at results quite closely. What did you make of the Hero MotoCorp numbers as well?
Yeah, it is second question first. Hero Motor a little disappointing, but then I remained pretty confident. The top line started showing good growth, and also considering the recent rural spend on infra, I am pretty sure Hero MotoCorp will come back to a growth trajectory. for bottom line as well as for the market cap build-up. Now, as far as market is concerned, as I've been fearing on the small and mid-cap space, we have seen the erosion of 11.5 trillion rupees in just 9 trading days from the peak value. In the process, a lot of stocks have corrected substantially in the mid-cap space. So from Friday onwards, we started slowly buying good quality stocks in the mid-cap space. In fact, we bought yesterday also. We have changed our stance also. Earlier, I was saying only 35% for the mid-cap. Now we have gone for 50-50. 50% for large cap, 50% for mid cap, and we would be a buyer, even from today. On every decline, we would slowly increase the tilt towards the mid cap stocks.
A clutch of these mid caps, though, Mr. Chokkalingam, have come off quite rapidly. Good names out there in the NBFC space, in the auto ancillary space as well. Are you selectively picking and choosing from that pocket? I mean, what is it that you're liking the most?
No, in these two spaces, I still find more scope for correction because I'm not comfortable with anywhere around 4 to 7 times price to book value in NBFC. In automobile component space also, many stocks are still trading at 20-25 PE on current year trailing earning. So I am looking more at the mid-sized pharma companies, mid-sized private banks, particularly the old private sector banks. And, then as I covered earlier, stocks like Desco and some of the mid-sized PSUs also, because the budget has proposed 80,000 crore stake sale. Nothing has happened in FY18 so far in stake sale. But I think, with the GST target not being met and a lot of pressure on the non-tax revenue, at least in FY19, there would be a series of stake sale in the mid-sized PSUs. So therefore, we are focusing on mid-sized PSUs as well.
Okay. Mr. Chokkalingam, stay on. So much more to talk about. Let's talk about all the stocks that could be impacted today as well, some which will come out with numbers as well. I thought a clutch of names that came out with numbers yesterday were fairly interesting stocks to know. Let's get in our research team in full strength to talk about all of those and more. Results that came out post-market hours yesterday, some stocks in news and some companies that will come out with numbers as well today. Okay, guys, let's start off with the results that came out yesterday. I also want to talk about Hero MotoCorp with Yatin individually too.
So the first one that we're tracking is KEC International, where the company has reported a 26% jump in its revenue. Also, EBITDA, it's a fairly decent show in terms of the operational front. Net profit has come up by 79% year-on-year basis. EBITDA has jumped 34% there. Impact of GST seems to be phasing out for the company, and we're seeing some strong execution in its business segment. Second up on the list, we have Gujarat Alkalis and Chemicals. There, the revenue is up by 27% year-on-year basis, and both your EBITDA as well as your net profit, they've both risen by 2 folds in this quarter on year-on-year basis. You've seen, apart from operational efficiency decline in the finance cost, which is percolated well down in the bottom line performance of the company. Third on the list, we have Ashapura Intimates, where the revenue is up by 116% for this company. Net profit is more than 14-fold jump that we're looking at. It's basically a rise, sharp rise that we're seeing in other income due to the treasury sale shares, what is working out in the favor of this company. Ramco Industry also, again, good set of numbers reported by the company. The revenue is up by 124%. Net profit is shot up more than 100%. A good performance coming in from operational front too. In terms of weak earnings, we have REC, where the net interest income has come down by 9%, and also the profit for this companies have shrunk by 26%. Dish TV, again, a weak set of numbers that have reported muted top line growth that we're looking at for this counter. If you look at the company has reported a net loss as of less than 1 crore as compared to a profit of 10 crore that we've seen in the corresponding quarter.
Thanks a lot for that, Nikki. A couple of interesting things, though. I thought Ashapura Intimates had a really large one-off as well on the bottom line, as a result of which I think the number comes up to 38 crores. And Dish TV, guys, interesting. While the numbers were okay, they have, I think, decided to go ahead with the merger with Videocon, and that should also play on the minds of investors, right? Either of you tracks it?
No, so basically, there were, various issues regarding the entire transaction getting closed, but now since the transaction is getting closed, we'll have consolidation in the DTH space, and of course Dish TV having significant market share in those rural markets, semi-urban markets. Probably this acquisition will help them improve their overall market share. And analyst community in general have already factored in the positivities or probable synergies with the Videocon DTH acquisition. Probably there were some hurdles, and now since they have gone ahead, probably I think it could be a shot in the arm for the company in the short term.
Okay, while we are at results, I think a quick update. Hero MotoCorp, what are brokerages saying? How will the stock react today?
Well, Neeraj, brokerages have been maintaining the overall stance. If you look at Hero MotoCorp, the results were largely in line with the street expectations. No surprises on the margin front, no surprises on the top line. So clearly, it was a very stable quarter for Hero MotoCorp. Of course, moving forward, the kind of demand that we are seeing in the rural markets, probably that is something exciting which the management is talking about. The revenue growth was 15%, absolute EBITDA growth was 7.5% odd, and margins came in at close to 16%, which was the estimates any which way. So no surprises from Hero MotoCorp. Stable set of earnings, results meet street expectations.
Okay. Firstly, the stocks in news, and then the numbers which will come out today. Shraddha, what's standing out?
A couple of smaller names, especially on the back of order wins, Neera. So KC International, they've got orders worth 2,035 crores. Bajaj Electricals, they've won orders worth $4.1 million in Zambia. That's a relatively smaller name. Praj Industries, they've got a letter of acceptance for about 17 crores. And McNally Bharat, which has got orders worth about 68 crores. That apart, Max Financial Services has said that their board will meet on Friday to consider fundraising for its insurance arm, that is Max Life Insurance, for them to be able to pursue an organic growth. So keep an eye out for that name as well. JSW Steel is said to be closing on a deal with Monet Ispat, and an announcement is expected within a month. That's an ET report. So we could expect Monet Ispat to react sharply to that. Another ET report says that HDFC is exploring options to acquire a controlling stake, that is about 30% stake in Canfin Homes. So watch out for that name as well. And Vodafone is said to be in talks to sell its entire 42% stake in Indus Towers to Bharti Infratel. Again, a ET report, but let's see how that one reacts. So a couple of smaller names.
Okay, we'll watch out for all of these as well. KC numbers were fairly interesting too. Now to numbers that will come out today. And after Lupin's disappointment yesterday, Darshan, all eyes on large cap pharma.
Yeah, it will be, but it won't be bad given the fact that for Cipla, particularly because they don't have that much bigger of a US presence as compared to Lupin. So let's start with Cipla. We are seeing a revenue growth of 13%. As far as bottom line is concerned, a 23% growth. And as far as margin is concerned, above the 20% mark. Now, basically, if you're looking at the geographical breakup, India is one of their biggest markets, so 15 to 20% growth on the back of the demonetization quarter and coming out of the GST quarter. So that will be strong. US will be a growth of 8 to 10% when Lupin was a big degrowth what we saw. South Africa will be flat. Europe and rest of the world are expected to do well for Cipla this time around. Basically, the new launches that they had 4 big launches that will aid the US business for the company, and overall they have been every quarter they have been bringing in operational efficiencies that will aid the margins for the company. Now, as far as Aurobindo Pharma is concerned, yes, they have a large US presence, but nevertheless we see a 9% growth on the top line. On the bottom line, we see a growth of 14% and close to an 80 basis point improvement in margin. Now, the reason here is that US competition will definitely affect them. Some of their key products like Renvela and Pantoprazole have been hit because of pricing pressure, but they had a slew of new approvals and launches that happened in the quarter, both in Europe and in US, and that will actually offset the loss that is there in some of the key products. Overall, we are expecting close to $300 million of sales to come in this time around. Both API and formulation business are expected to show slight growth this time around, and the higher share of injectable products and a better product mix is something that will aid margins for Aurobindo Pharma.
Okay, we'll watch out for these two as well. And Yatin, very quickly, Eicher Motors, what to watch out for?
Eicher Motors, of course, to watch out for will be the standalone margins, which are expected to be, quite strong. We are expecting a 30% kind of a margin there. Consolidated margins also seen close to 32%. Of course, if you look at the Royal Enfield business, that has shown a strong volume growth of 19%, because of which the overall, growth metric for the company will be quite strong. We see the EBITDA margin seen at close to 9.5%, and that is something we'll be watching out for. On an overall basis, expect a 20-22% kind of a EBITDA growth and a revenue growth for Royal Enfield as well as VC, which is the consolidated business of Eicher Motors. It should be a decent show as far as the margin performance is concerned, because the company had taken price hikes, and the overall operating leverage on the back of good volume growth would be aiding the overall performance.
Okay. Watch out for all of these. Thanks so much for joining today, all of you guys. Mr. Chokkalingam, have you looked at KC International? The numbers were good. They received fairly decent order inflows throughout the quarter as well. Any thoughts on the stock?
Yeah, quite impressive in this market and these economic conditions. Stock also corrected, nearly more than 10%. So definitely one can consider buying for short-term perspective, but possible to get at least 10% upside from this level.
Okay, 10% upside from these levels. So, yep, do watch out for KC International as well. Mr. Chokkalingam believes that that could be the case. Let's get in our technical experts on board. About time really that we do that. And start off with Gaurav Bissa. He's a derivatives analyst at LKP Securities with his thoughts on the markets as well. Gaurav, throughout this grind, if I can call it that, we've not had big short positions built, unless I'm very wrong. It's been a case of a lot of unwinding that we've seen on multiple levels. How are you approaching trade today in that light?
Good morning. Well, for the reason that we have not seen such a massive short portions considering the kind of fall that we have seen in the broader markets, the reason is that Nifty has been playing on the gap up node or gap down node. Today also we'll see a gap up node. Yesterday we had a strong gap down. Day before it was a gap down. So thing is that once there's a gap down, the potential of fresh shorts or fresh longs that reduces to a significant extent. And also people have got off guard. People are not expecting such a ferocious fall to speak of. So maybe that is the reason, and there are a lot of portions that are liquidated, and that is the reason why we are not seeing too much of short portions. Rather, it has been more of a long unwinding, as you rightly said. And as far as the way going ahead, I think 26,400 for the bank Nifty is a very crucial level. That is the weekly resistance. We saw a 1,500 point correction, almost 1,500 point correction coming in the bank Nifty. So that now becomes a very strong resistance. Until we don't close about 26,400, I would not be putting my money saying that we are coming out of the woods. I would rather buy a put option if it trades near 26,400. We have an event today also. There's a possibility we may see small major reaction coming in. So on that front, I think buying a put option would make sense rather than being all in out and buying very aggressively in the market. We have already seen a strong recovery in last 2 days. So I think one has to be a little bit careful, be very selective in picking the right stocks. There can be some more volatile movements in coming days.
What are the stocks you're recommending then, Gaurav?
First one would be Escorts. This is the one stock that is has not seen a good correction, any meaningful correction at all, so to speak. It gave a weekly breakout. A lot of long positions seen getting built. If you look at the kind of data it is showing, we're not seeing significant long unwinding as well. Rather, some amount of longs have been added even in such market on the verge of giving a new breakout sort of. One can have a small stop of 878 on the upside. 950, 920 would become quite possible. Second would be buy on Jubilant Foodworks. This is another name that has not corrected too much. It's been on the uptrend. Not aggressive short position I've seen getting built. Not much of a liquidation as well of long positions. And with this small sort of 955 on the upside, targets of 2030, 2050 can be seen in a day or two.
Okay. Thanks, Gaurav, for those recommendations. Time now to get in our segment Bloomberg Edge, wherein Jayesh Kilnani brings us a trend that the Bloomberg terminal has thrown up on a particular stock. Jayesh, what's the stock today?
Morning, Neeraj. I'm watching out for Motherson Sumi. Primary reason being that the stochastic indicator has turned positive, and also that yesterday the stock actually tested its 200-day moving average and bounced off that. So, potential upside based on that reason as well. But first, let's have a look at how the stochastic actually works. Well, it helps you to identify when the price move is overextended, and it measures where the current price is in context to the recent high or the low that the stock has clocked for itself. Now a few conditions that you have to watch out for. Overbought is above 80 and oversold is below 20. There are two lines which get plotted by the stochastic indicator, and a crossover between the two lines gives you a buy or a sell signal depending on the direction of the crossover. Let's have a look at the chart of Motherson Sumi that we have. So we can see that so about 340 is where the 200-day moving average was placed, and the stock actually bounced from there and closed higher at about 356. Bottom panel shows you the stochastic indicator, and you can see that the blue line and the white line that has actually crossed over, and both of them are above the green line, which indicates or gives you a confirmed buy signal as per the stochastic.
Okay, Jayesh, many thanks for that. That's one chart to watch out for, Motherson Sumi. Let's ask Meghana Malkhan what else is she watching out for. Meghana, thanks so much for joining in. Let's first, since we're on the topic of stocks, get in the stock recommendations out of the way. We'll get to the index recommendation in a bit as well. But are you indeed taking any stock-specific strategies in a scenario like this?
Yes, good morning. There is, in fact, if you see the overall entire market, I do have stock-specific strategies. IT in particular has been doing well. So in this particular phase where you see, the corrections happening on the mainstream stock, I think one could better be sticking to the IT. Polaris is something that I like in this space. Polaris also a low risk buy considering the momentum that is really keeping the stock up. You could buy with a stop of 430 for a target of 480. And the second one that I like from this pack is Emphasis. The stock is really holding on. The volumes have been going good throughout, and the candle patterns also have been showing bullish formation. So Emphasis is another one that I would like to pick on a specific note today with a stop of 835 for a higher target of 925.
Okay. A couple of interesting names there. We'll also get in Meghna's index trading strategies in a bit, but I just want to discuss 2 or 3 numbers that came out and 2 or 3 stocks in news as well. Now, KC International is one that we spoke about with Mr. G. Chokkalingam. Good numbers, new orders were 2,000 odd crores. There is some buoyancy there. There's some other strong numbers that came out, Mr. Chokkalingam, all mid caps and small caps. If you track any of these, Gandhi Special Tubes, Gujarat Alkalis, or Shanti Gears, or for that matter, even Ramco Industries. Do you track any of these names?
Yeah, I've been tracking for quite a long time, all these 4. In terms of valuation, there is a comfort in Gujarat Alkalis and to some extent Gandhi Special Tube. Other 2 stocks, there is no valuation comfort. They have multiplied substantially in the last 2 years. So therefore, I would stick to Gujarat Alkalis and Gandhi Tubes.
Are these good investment bets, Mr. Chokkalingam? Gujarat Alkalis or Gandhi Special Tubes?
It's a good question. Gujarat Alkalis has almost ran up 150% in the last 18 months. Maybe for short-term investors, considering the fact that caustic soda prices are very good, and they are making a steep profit for Gujarat Alkali, and also the stock has corrected from the peak by 15%. There is a possibility of these 2 stocks, Gandhi Special Tubes and Gujarat Alkali, giving you 10 to 15% upside in the short term. But for a very long term, I won't buy. I mean, there is not much opportunity to multiply our money in these stocks.
Okay, Mr. Chokkalingam, the last time, actually not the last time, but one of the shows that we did, when we had asked you about a stock that you would be comfortable buying and holding for the next couple of years, I think you'd spoken about Karnataka Bank as being your top bet. Is that still amongst the top stocks that you would purchase in the current market environment?
Certainly. Certainly. It is the cheapest stock. It is trading at just a one-time price to adjusted book value. If you look at all the listed banks, there are 27 banks listed. Karnataka Bank is the cheapest bank, and not only that, net NPA in the last 2 quarters sequentially it has improved, and it has crossed the benchmark of 1 trillion rupees in business size. And third, surprisingly, this bank has managed to grow its credit in double digits for the last 2 quarters consistently. So, in fact, this is one of the topmost holding for my clients. Even personally, I have invested, and we have been buying for last 2 days quite aggressively using this recent correction.
Okay. Meghana, I want you to come in on the brokerage names. Motilal Oswal, of course, got beaten black and blue. But Edelweiss and IIFL, after correcting a bit yesterday, seem to be finding some bit of bottom. Are these good trading opportunities, either of them?
Well, if you really have to see the price support, Edelweiss is a little farther away because if you see the daily chart, the price is actually trying to tag the lower part of the volatility band. I would say the support is a little far away from here. I did look out for signs of bottoming on some kind of consolidation before we get to see some price rise on Edelweiss and ILFS from right now. I think we could wait for another, on Edelweiss especially, I see another 10% dip from here. Considering the way the momentum is behaving on the weekly chart, I think we could wait for a while. Right now is not the good time to enter.
Gaurav, one stock that Navneet pointed out, Jain Irrigation, has been caught in an eye of a storm. Yesterday, some interesting trades as well. What's your view here? Irrespective of what happens today because of the ban or otherwise, what's your view here?
Well, it has been quite volatile of late, and there has been good support at 105. On the other hand, 120 call option had a very high concentration, still commands one of the highest OI concentration. So as long as it's trading below 120, I would not be too keen on jumping the bandwagon. I would rather wait for it to cross 120, in which case we can have a 2% stop loss, 10% kind of targets, or at least 7-8% kind of targets. So that kind of risk score is quite favorable. At the closing price of 115, I am not too keen. I would rather wait for a dip towards 107, 108. That is the level from where it has been bouncing quite strongly, and that is where you can expect a better risk reward as to what it is providing right now. So I would wait for the time being. I would not buy the current price.
Okay. Stay on. So much more to talk about. About 20 seconds to go for the markets to kickstart trade. The SGX Nifty is half of what it was about an hour ago. So keep that in mind. Shanghai Composite is down in the red too. Nikkei is up about 3%, yes. So the Asian picture is also mixed. But more importantly, the SGX Nifty is substantially off from the levels that it was trading at. So we may argue that the Dow uptick may really give legs to our markets today. The SGX doesn't quite point towards that. And the pre-open rates seem to be starting about the levels at which the SGX Nifty is indicating. So about 100 odd points for the Nifty. Could be a few points here and there. The Sensex about 0.75%. So this is pretty much the levels at which we could kickstart trade in the session today. Want to bring up some stocks. Yesterday's session, we saw a sharp recovery in the latter half of trade for Bajaj Finance as well as ICICI Bank. More so Bajaj Finance. Let's see how those two are starting off in the session today. Marginal greens for Bajaj Finance. Let's see if ICICI Bank has some spurt to it. About 1.5% pre-open session. IT was the big loser in trade. Almost all the large cap IT names were pummeled, about 3 or 4% for each of them. Today's session, some bit of an uptick, so not bad. Some results that could be reacting, or stocks that could be reacting to results. So we should get in Hero MotoCorp firstly. Well, a couple of percentage points higher right now. An average quarter really maybe subpar. For now, the stock is showing some upticks. Let's see if these rates change. And then KEC International and Dish TV from amongst the liquid stocks. KEC, good numbers, margin expansion, strong order wins. I don't know about a 6.5%, but should start off okay. Dish TV, the only positive, and I think it's come in the brokerage notes as well, is that they've decided to go ahead with the merger, and that may be net positive for Dish TV on a valuation per share basis. Otherwise, the numbers left a lot to be desired. So this seems to be the order of the day right now. Specific moves to a lot of small caps, and we'll talk about them as well. But the large cap space seems to be okay. Reliance and HDFC Twins too could be very, very interesting. Mr. Chokkalingam, before we thank you, just one quick word on Dish TV individually. Do you track this one, and the fact that while the numbers have been disappointing, they have decided to go ahead with the merger, something that was in the limbo, but now seems to be moving ahead?
Yes, I have been tracking it for quite some time, but I have advised my clients to exit the moment Jio became aggressive, in promoting data segment. I firmly believe that that's going to be negative for all the players like Dish TV, Just Dial, because Y segment there is no enough growth for mobile operators. They have to get into data segment with value-added services, and they are in a better position with a strong internet platform. So this is going to be a major risk factor for all other players, who add value to internet platform and package their product. So therefore, I would not touch the stock.
Okay, Mr. Chokkalingam, we'll let you go on that note. Thanks so much for taking the time out and being with us today. Okay, and that's G. Chokkalingam with his thoughts. Let's get in Deven Choksi of KR Choksi Securities. He joins us right now on the show. Deven, good morning. Many thanks for joining in. What have you been telling your clients to do in the last 2 or 3 sessions post-budget? Buy selectively, or only nibble, or stay away until the storm is passed? And the question is, has the storm passed? Because while the SGX Nifty started off 1.5% higher, right now it's just up about 0.5%.
Yeah, good morning, Neeraj. In fact, I think as early as Monday morning itself, the client communication was very clear that this particular fall has got nothing to do with the budgetary proposals on LTCG, and it has to do largely to do with the higher amount of unwinding which is taking place of the position in favor of debt market from the equity market globally. So I think the fall which is in such a rapid manner which is happening could possibly get arrested also equally fast. and we maintain our view on this particular subject. The kind of fall which we have seen in the market, unwinding pressures that we have seen in the equity markets, I think can't sustain for a longer period of time. Remember one thing, that even if the money has to go into the debt market due to the higher yield proposition out there and the valuation advantage that you get there, at the same time I think you are also getting good amount of opportunity of growth in the equity market. America is growing at GDP of 3.5% already. So is the trend emerging from Europe as well. And I think India as a country particularly is showing a distinct signs of growth of around 8% plus. So given that kind of a situation, equity would remain a preferred destination, even though some kind of sell-off I think would happen in between because of the higher positions, in particularly I think on the technical side. The market could possibly give some correction. The second message given very clearly was that I think this kind of market is giving you opportunity. In a perfect bull market like this, you would get such kind of opportunities when the sell-off would take place for some reason, and that would be a buy opportunity. So once again, I think this is an opportunity that one must not miss out. The third aspect is individual businesses, where we believe that I think the businesses look interesting are the ones which are driven by the growth momentum. At the same time, the budgetary proposals, likes of insurance. Even consolidation within public sector banks would mean that some of the larger banks would be beneficiary eventually. So it's good time to I think buy into them on a contra basis. Selective mid-cap stocks where the growth continues because of the ancillary status that they enjoy, along with the mainline infrastructure stocks. I think that's where again I think we have put across our emphasis. So yes, I think our approach has been selective. In such kind of market, sell-off should be utilized towards buying into the portfolio and strengthen your portfolio at lower levels.
What insurance companies do you like, Devin? Because the budget was arguably more favorable for maybe health insurance companies, optically at least. Or did you find enough reason to buy into life insurance too? And what within there? Because the valuations for all three companies are just starkly different from each other.
Absolutely right, and you are spot on with the valuation. That's where I think we probably think that it makes sense to I think go with the companies which are basically I think at a premium valuations. The reason is very simple. In insurance business, how you manage your cost structure, how you manage your product distribution is something which brings the profit to you, because ultimately I think that's the spread in the cost ratio that you are enjoying. Cost ratio versus the new business premium, I think that's what you are enjoying. So certainly I think we feel that the premium one would be the buying into the HDFC Life. I think that would be the better of the lot, followed by SBI and ICICI Prudential. Bajaj twins are definitely under Bajaj Finserv, so one would probably I think want to stay invested in Bajaj Finserv at such levels, and probably some correction would mean buying opportunity into them as well. Generally we like each of these companies because they are by and large following a very matured model, and that's where I think one would not like to create a very clear distinction among them. Other than that, I think distribute equal money amount into each of these companies and allow the sector to grow, and probably I think you get the maximum benefit out of that.
Okay, Devin, any thoughts on these two, Vakrangi and PC Jewellers?
No idea, Neeraj. I think I have refrained myself from getting into this particular subject, so pardon me for it.
No, completely fine. Understandable as well. A stock that is starting off very well, Devin, is KC International, up about 6%. I think at the end of 7 minutes, it seems like it'll start off really well. Margin expansion of about 50 basis points in this business, plus new order wins of about 2,000 crores, certainly showing that the order inflow keeps on coming in. What are your thoughts here on KC or any of the other ancillary business, power ancillary businesses?
Yes, absolutely. That's what I was referring to, that I think companies which are connected with the infrastructure and I think the ancillary businesses, they are definitely, I think the KEC's order book position is validating the entire game plan that these particular companies are talking about. My reading says that I think the likes of ABB, likes of Schneider, likes of Siemens, even GE&T, those kind of companies are very well equipped to handle the larger part of the business, and they have been getting a huge amount of order book position now. Fortunately, in last 10 years, since 2008, many of these capital good companies have also cleared their balance sheet with non-performing, non-recoverable assets, that is their debtors, cleared I think non-performing inventories, and I think the balance sheets are quite clean for most of these companies. today the situation is that they have started receiving the new orders, and more importantly, I think we are seeing the Industry 4.0, which is the new way of, I think, working in the entire industrialization era. You are having Internet of Things coming in, wherein the new technology would drive service-related businesses for many of the capital goods companies, and that's where some of these major companies have been employing their resources today. So we believe that I think this is a generation next business which is happening or emerging very fast. Some of the companies are definitely trading at a premium valuation, but as I said, that those who have the capability to execute would probably be the most preferred vendor for many of the businesses which are coming up. So we like, even though ABB kind of company remains premium traded, we like ABB into the investment with a 3-year view from now.
Okay. Then hold on, I will take in one final thought from you as well, but just showing the pre-open rates as they've settled down, the 8 minutes have gone by, and we're likely to start off about 1% higher. Let's wait and watch though, because the SGX came off quite rapidly from those levels. So interesting to see if we indeed start and stay at those levels or no. Meghana, Malkhan, I was talking about getting your index strategy. What are you doing here? I mean, let's assume we start off about 1% higher. Is there a call on the index that you would give out?
Yes, index, if you specifically see Bank Nifty, the stock has been, the way it's been moving, momentum is poised right now at a good support. This is daily chart, daily RSI is poised at 40 right now. And also considering the bullish pattern that we got yesterday with good volume, I think this is the point where we may break and head towards the 20 period moving average in the daily chart. So this calls for a buy at the moment. I see the resistance coming in at 26,570 levels. So this is what I would aim for at the moment.
So you would buy it at about 1% higher level, because the Nifty Bank 2 will start off about 254 points high.
Yeah, but ideally, I would the right stop loss that I would place on the buy list would be the yesterday's close. If I have to buy on the buy trade, the right stop loss would be yesterday's close. So the nearer that I get to yesterday's close, the better it would fit in the risk-reward ratio, and the target could be 26,570 on this trade.
Okay, minutes away from markets to kickstart. Let's tell you all that you need to know to stay ahead in trade today. Global equities rally, but commodities fall. India awaiting the RBI policy review today. Aurobindo Pharma, Cipla, Eicher Motors, Prestige Estates and IRB Infra are amongst the large numbers that will come out with the results today. A strong quarter for KEC International, Ashapura Intimates, Gandhi Special Tubes, Gujarat Alkalis and Shanti Gears, all stocks starting off in the green. Hero MotoCorp, Thermax and Heritage Foods have come out with numbers that meet estimates. While REC, Dish TV, DIC India and Cupid have reported weak numbers. Lastly, Gen Irrigation enters the F&O ban, while India Cement and Wockhardt exit the F&O ban. Okay, now just before we take in the top call from our experts, Deven Choksi, one quick thought. If you had to bet on one business currently, I know you gave us a slew of businesses, but would HDFC Life be the top bet, or are you looking something which has got slightly better valuations, even if it is the mid-cap end of the market?
So I think we have plenty of them, and particularly we like some of the larger ones which I have mentioned, HDFC Life. Along with that, I think we are particularly very bullish on one situation, which is a pipe model which is emerging out of the internet way of distribution of content, wherein I think the content providers would become, I think, very strong with the internet way of distributing the content out to people. And I'm referring to the experiences like Amazon Prime and Netflix, I think, which people have started enjoying. I believe that I think some of those companies which have got the ability to produce the content and pipe it to the distribution reach through, say, for example, network like mobile telephony network, they would be probably the right choice of a business as one would like to look at. Unfortunately, we don't have a very single company, I think, which has a pipe model in place currently. But we do believe that in Reliance Group, I think Network 18, TV 18 could get probably, I think, into the Geo framework eventually, and that could be the right choice to buy into the model portfolio, and that's where I think Reliance could become a good choice to investment. Of course, I think we have been asking Reliance to buy from the core business portfolio itself, but Geo, I think, is throwing a better proposition now. So if it is a separate company, certainly I think it would have gone as a separate recommendation to buy into the portfolio, but otherwise I think Reliance in its corrective downside also remains an equally a good opportunity to add into the portfolio.
Okay, a minute to go for trade. Let's see how we start off trade. But if you had to bet on one stock for the day, let's ask our technical experts and our derivative experts that one top idea for the day today. Gaurav, Bissa, if I can start with you first. One stock that you would bet on today.
It would be Jubilant Food. I think the kind of data that is seeing, the kind of momentum it is showing, I would not be surprised with a 4-5% up move in 2 days. Today itself, we can test levels of 2040, 2050. So that would be my bet. Wow.
Okay. Gaurav, Bissa, won't be surprised if there's a 4 or 5% up move in Jubilant. Meghana, Malkhan, very quickly, your top call for the day today.
Well, I'd like to go for Tata Steel, just based on purely on the price pattern and the volume pattern of the last week that is emerged. Tata Steel is a very low risk buy for the day with the stop of yesterday's low, and the target for the 20-period moving average, which comes at 710.
Meghana, Gaurav, many thanks for joining in today and giving us those ideas and your thoughts as well on the index. So Tata Steel and Jubilant FoodWorks are two top calls on Bloomberg Good Mornings today from our two experts. Let's see how the market is starting off. No surprises there, about 1% higher for all the three key indices. The Nifty Bank about 220 odd points higher too. So not a bad start to the trading day. The broader end of the spectrum too, I would reckon, would be showing some ticks of green. So won't be surprised there. 1.5% higher for the mid caps, about 1.5% for the small cap index as well. We're off to a good start, ladies and gentlemen, in the session today. Fair bit of green. This is a stark contrast to what we've seen in the previous 2 days this week. So this is, well, for a bull, heartening as well. SBI from amongst the banking stocks leading the charge. The OMCs are not doing too bad. Reliance Industries is right out there somewhere in the green, about 1% higher for Reliance Industries too, and not too many losers. NTPC maybe 1.5% lower, but that's only par for the course. Yesterday it was withstanding the selling pressure. Today the trade has shifted to the momentum side, so NTPC is a bit quiet. Lupin continues to drag lower though after a 6% slam dunk yesterday, another 1.5% in the session today. So this is the picture. OMC is essentially the key stocks in the session at the start of the trading day. What about the mid cap and the small cap end of the market? Clutch of names which came out with numbers, and just want to mark some stocks in the session. The result boys. So firstly, Hero MotoCorp was a weak Q3, or maybe people would argue in line with estimates, a stock about 1.5% higher. What about the mid cap end of the market? Those are some stocks that I want to highlight. KC International, very strong Q3. New orders to the tune of 2,000 odd crores, and the stock starts off about 5% higher. It's a strong move for a KC International, to be honest. A clutch of other names that came out with very strong set of numbers. Gandhi Special Tubes was one such stock, about 1% higher. Gujarat Alkalis 3% higher. Shanti Gears about 3% higher. So strong move there for Shanti Gears as well. I also want to mark what's happening to Ramco Industries. The Q3 PAT up 140%, margins have doubled. It's a stock that's moved up quite a bit, but still up another 3% today. So the last 1 year strong moves, and in today's session too about 3% higher. And Tuesday's big gainer, Bhushan Steel, no surprise there. There are some specific fundamental reasons for the same as well. The stock up another 4 or 5% in the session today after a 12-15% move in trade yesterday. So good moves really for those stocks as well. So by and large, the moves seem to be good. I just want to bring up a couple of other stocks on the wall as well from yesterday's session. So one is Vakrangi and PC Jewelers, and just trying to ascertain as to what's happening to those stocks in trade, because yesterday with the market getting beaten down, both those stocks were down. And while PC Jewelers may have a tick of green, Vakrangi not having any such luck. I believe the circuit filter would have been revised. The stock is down 5%. PC Jewelers, on the other hand, after going down 7 or 8% yesterday, is up about 5%. By the way, in moments from now, we'll get Krishna Kumar Karwa as well, and we'll talk about his thoughts on the markets too. But PC Jewelers up about 4 or 5% in the session today. Last but not the least, Jamna Auto had a big last 2 days. Let's see if it's reacting positively in the early morning trade today. Well, another 2% higher. So select auto components seem to be doing well. I heard Yatin telling me that some auto companies have been talking about how their auto component inflow or other, there's a shortage of auto components. I don't know if it's really helping some of these stocks as well. But let's get in a very special market voice. Krishna Kumar Karwa, and he's no introduction, joins us right now on the show with his thoughts on the markets and the current pullback that we've seen. Krishna, good morning and thanks for speaking to us at Bloomberg Quint. This is Neeraj here. What's the central message that has gone out to a clutch of your large clients, your FI clients as well? Stay calm, stay on the sidelines, or start nibbling away because the valuations are a lot more attractive than what they were?
See, I think, first of all, thank you for inviting. And yes, I mean, the kind of sell-off, the savage sell-off which took place in the US, I think it has caught investors unaware. And India investors also had to bear the brunt of it. But such kind of big moves, I mean, okay, yes, markets have recovered yesterday in the overseas and we will also recover over here. But that doesn't mean that the overbought situation which is there in the market and the way the way the markets have gone up in the last 12 to 18 months, that takes away the basic underlying overvaluations which are there in the system. So our point of our communications to investors has been that we continue to stay focused on bottoms up, earnings focused and valuations focused investing, because these surges of liquidity and sell-off, I think it's very difficult to be able to get the hang of it. So we have seen that in the last 1 year we have had very good domestic liquidity driving up our markets despite earnings not being so strong. And now similarly now overseas liquidity seems to be under some question mark and we have seen a sell-off. Now these kind of things are very difficult to predict. But the last quarter numbers, if you see, have been very, I mean, as per expectations, and the expectations going forward also seem to be robust. So we are very optimistic about the earnings growth for the coming 1 year, and we believe that wherever stocks are getting unnecessarily corrected and where fundamentals are strong, those are the stocks which you should continue to back.
Okay, Krishna, I'm glad you're talking this because, I mean, it's a slightly different point of view from what I've heard in the last 24 odd hours. My question to you is this. A lot of the broader market stocks, good names as well, have come off quite a bit. Now, we all know, or I believe all of us would agree on probably one thing, that as things stands, we seem to be on the cusp of an earnings revival, which may last 2 or 3 years or probably more as well. So stocks which may be appearing slightly expensive right now will appear fairly reasonable 2 or 3 years valuations down the line. My question to you is, in a scenario like this wherein the markets have shown the first signs or a first hint of a drawdown, is it prudent to put money to work into some of those companies which are probably slightly expensive right now but look reasonable 2-3 years down the line? Or do you believe that there will be better buying opportunities? There is no doing away the fact that we are probably in the midst of a bull market, but even a bull market would probably give better buying opportunities as well. What is it that you are playing for?
See, any prudent investor, whenever he invests and whenever post such sharp corrections, yes, I think what they typically do is that obviously you do put some money to work in the stocks for wherever valuations look reasonable and where you are very confident of the next 2-3 year prospects. But at the same time, you are also prepared that sometimes markets can be irrational longer than you can be solvent. So you keep your powder dry also to be able to buy more if the markets correct further. So to answer your question, should you be looking to invest in stocks which have corrected, which could be slightly expensive, but where you are confident of over a 2-3 year period? Yes, you should be doing that, but with the caveat that you never know. That we have seen one round of global sell-off, and which have also followed up by in the domestic markets. Now, can there be a few more rounds of sell-off in the next 2 to 6 months? There is a distinct possibility. And also we need to understand that we have had very strong domestic liquidity flows in the last 12 to 14 months. Now it will be important to see how this domestic liquidity which is coming through the mutual funds, how this behaves in the coming months as such. Does it continue to be in the same, with the kind of same ferocity the way it has been earlier, or will it become slightly muted? I'm not talking of negative flows, but what I'm just saying is maybe the quantum of flows could get reduced, and that will also have its own impact on stock value, on the buying which will come from the domestic fund into such stocks. So we'll have to balance the fundamentals along with the liquidity, and over a longer time, as you are all aware, I think it's the valuations which play out, but you also need to be aware of the liquidity situation, both domestic and global.
Okay, so here's my question. All through the last 6 months or maybe the last 12 months, the talk has been of financialization of savings and how that will play a big part. And, you know, often the term has been used that we have only seen the tip of the iceberg. The whole quantum of flows is yet to be seen. Do you think that whole theory is getting challenged right now? Or I mean, I'll tell you the contra view. The contra view is that this will continue and only get aggravated, this whole financialization of savings, because it will now reach the nooks and corners of the country and more money will come into the domestic funds.
I don't deny that there is this whole financialization of savings has just begun, and we are seeing the first signs of that in the last 12 to 18 months. There is no doubt about that. The investor awareness about the whole mutual fund opportunities of investing through the mutual fund route, etc., is just beginning, and we are seeing the benefits of that in terms of the last one year of robust inflows. What I'm just saying is that it just doesn't move in an Excel spreadsheet. Basically what I'm just saying is that maybe there could be some kind of a tapering off where it could become more reasonable than the way it has been. And also what you have to understand is that in the last 6 months there has been major inflows which have been happening in the balanced funds as such. Now the balanced funds category, where people expect that monthly dividend, etc. Now maybe those kind of funds, the inflows in those kind of funds may now take a breather because markets are under challenge. Even the debt part of the portfolio over there also could be under pressure. So industry has to reinvent itself in terms of what is the new product that needs to be sold to investors. So I'm not saying that the financialization of savings is under threat in any fashion. What I'm just saying is that there could be some tempering of flows which could stabilize at maybe slightly lower levels. The SIPs and all are not going away. It's about the opportunistic money which comes into the market during boom times, or rather when the markets are strong. Those kind of investors would be possibly looking to reduce the exposure. And also please understand that there has been a relatively poor economic environment in the last 12 months to 14 months post demonetization and GST. So even SMEs and MSMEs whose businesses were under pressure and who had extra liquidity, they have also tended to put money into the equity markets through mutual funds, etc. Now when the economy picks up, I'm sure they would be requiring the same amount of money for their own businesses. So maybe that kind of flows, etc., could also taper off. The regular savers are going to be there in the capital markets.
Okay, it's a fair distinction, and thanks for making that too. By the way, as we speak, the markets have come off a little bit from the highs of the day. No alarm bells, but still from about 1% higher to about 0.75% now. Actually, slightly less than that. So just about 75 points for the Nifty, and about 220 points for the Sensex. So that's not much really. It's just about par for the course day. Krishna, one final thought, and you know, I've heard a lot of commentators say this, that with the threat of the rising yields or rising interest rates maybe as well in calendar year 18 in India, the theme which played out really well in 2016 and 2017, which is NBFCs, might reverse a bit. It might be prudent to get out of some of the NBFCs and park the money into private banks, because banks will typically grow better in a high interest rate environment. Do you subscribe to that theory?
Partly yes and partly no. I think one we have to distinguish is that NBFCs as a category, I mean, there are so many different product lines that many of these NBFCs cater to, and they fulfill a very strong gap which is there in the banking system. So you can't wish away the basic premise behind investing in NBFCs. So to answer your question, as far as they have had very good run in the last 2 years in a falling interest rate environment. and the valuations of many of these NBFCs have also got stretched. So my sense is that whether you use the excuse of rising interest rates or otherwise, I think NBFCs are in for a consolidation as far as the capital markets are concerned. And as far as pricing power is concerned, maybe the housing finance companies or the housing finance NBFCs, I think they are under maximum pressure as far as the rising interest rates are concerned, and maybe they may not be able to pass on the rising interest rates to their customers because it's a very competitive market, and where also public sector and private sector banks are equally competitive. So those NBFCs could be under maybe slightly more pressure. But the NBFCs which are more into consumer finance or more into used commercial vehicles finance or into rural India, those segments of the NBFCs, I think the banks themselves are not in a position to cater to those kind of customers. There are some specializations which are required, and where this 50 bips or 100 bips interest rates, if they move up also, I'm sure they will be able to pass on, and their underlying business itself is growing very well. Or rather should grow very well, and I'm sure they will be able to pass on the rising interest cost to their customers.
Just one quick thought, Krishna, since we brought that topic up, housing finance, etc. What about housing companies? I mean, would you dismiss the moves in 2017 as the flavor of the season, or is there a structural bent to this story wherein investors, long-term investors, can make use of the current volatility to place some new bets?
You mean to say housing finance companies or housing real estate companies?
Real estate, housing real estate companies.
Yes, so as far as housing real estate companies are concerned, yes, I think in terms of post the application of RERA, etc., I think it's the stronger companies which will do very well, and whoever is into a segment which is relatively affordable. So basically housing real estate companies are more a function of the region that you operate in, and we have seen that strong brands and strong companies which are they seem to be getting more and more a market share in terms of bookings or in terms of investor interest or actual consumer interest. So my sense is that going forward there will be brands which will do very well. The mom and pop shops or the poor segment of developers who have given a bad name to the industry, so they will struggle. So to answer your question, yes, valuations have run up in many of these companies, but I think over a longer time frame, some of these companies will continue to do very well, and so we continue to remain positive. In fact, once the whole overhang of extra inventory, etc., gets cleared off over a period of next few years, these companies are the ones which could possibly give you very good returns over a longer time frame.
Okay. And are you by any chance, Krishna, taking any contra views on the exporting spaces? And let me limit myself to the two large pockets. One is pharma, wherein the contra view now would be go out and buy them, or IT, wherein the contra view would be now that maybe all may not be as hunky-dory as people are pricing in it to be. Earlier IT, the contra view used to be go out and buy IT. Now the contra view seems to be don't go out and touch IT.
So honestly speaking, we have been positive contra on IT for the last 6 months, and mid-cap IT have delivered decent returns in the last 3-4 months, and so has the large-cap IT, and primarily driven by the valuations that many of these companies were enjoying and the conversion as far as EBITDA to cash was concerned, so or rather the cash conversion which was happening in the companies in terms of the profits, and the high dividend payout for the buybacks these companies were doing. And luckily that has paid out very well for our investors. At the same time, if you believe that the global economy is doing very well, with US itself doing very well, then I'm sure that many of these IT companies should be having some kind of tailwinds which should drive growth for them going forward. But yes, they have run up reasonably well, and I mean, if investors are willing to take some money off the table, I think it's fair enough. As far as pharma is concerned, there are some structural challenges which are still there in the system, and the valuations of many of these pharma companies have come off, but still they don't offer as much of a margin of safety as we had thought, and things are getting pushed back and back. So earlier we had a view that maybe FY19 would be the first year when you could see things improving for the top 4, top 5 pharma companies. But currently it doesn't look like that things are going to improve maybe before FY20 and maybe second half. So I think still there is some pain in the pharma companies, the top 4 or 5 who are focused on the US generic markets. So I think there is still a challenge. We are, as normal value investors, tempted to look at the pharma companies. But I think there will be still some more time to go before you generally invest in these companies.
Okay, we'll leave it at that, Krishna. Many thanks for taking the time out and speaking to us at Bloomberg Quint.
Thank you.
Well, that's an important market voice, Krishna Kumar Karba, with his thoughts saying, don't be a braveheart. There could be some more downticks. Invest selectively. On the other side of the break, though, as we take one, we'll discuss the monetary policy expectations with Ashish Parathasarthy of HDFC Bank and Manish Wadhawan of HSBC India. Stay tuned.
जॉब अरे 5 to 9 जॉब भाग दौड़ all the time job the roaming वाला job the deadline वाला job or are you living in the market वाला job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
RB Sanjeev Goenka Group, growing legacies.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
You're watching Bloomberg Quint. It's monetary policy day, and while a lot of people will tell you that there is no change in the headline interest rate expected, this is an interesting policy, especially given the backdrop of the money markets that persists. Joining us to talk about some of that backdrop and what the MPC should be looking at, two of the best voices in the Indian money markets, Ashish Parathasarthy of HDFC Bank and Manish Wadhawan of HSBC, joining us here to discuss all the aspects that will go into the decision this time around. Ashish, I'm going to start with you. Good morning. It's been a while since since we've had you on. So let me just ask you for your backdrop as you see it to this Monetary Policy Committee decision. I know no headline change in rates is expected, but it's a complex situation given what's been happening in the bond markets.
Good morning. Yep, I think the bond market has seen a kind of carnage, I would say. However, if you look at the backdrop to the monetary policy, let's see how things are. If you first look at the global scenario, the global interest rates are looking to move higher. Liquidity is going to become lesser very clearly, and even now the market expects they're pricing at a small probability of 4 rate hikes during this calendar year in the US. Oil prices are high. They've obviously stabilized around this level, but they are around the 65 to 70 levels, which is higher than what it was a few months back. The budget, there has been fiscal slippage this financial year. The next fiscal target is the same or actually higher than what it should have been for this fiscal year. Fourthly, you are seeing there is a likelihood of inflation panning out to be higher because the government has said that they would look to hike MSPs, and there are other expenditures in the offing which could possibly lead to further fiscal slippage. Given all this backdrop, I think while we also don't expect any rate action, I think the policy language would flag all these risks to upside risks to inflation, and is likely to be more hawkish than we have heard RBI in the past policies. And they won't change their stance, they won't touch rates, but I think the market is likely to take an indication that the rate hikes are around the corner.
Manish, do you broadly agree with that view? I noted that some of the foreign brokerages in particular seem to be saying that we are overdoing these inflation risks. Are you with your foreign peers, or are you with the broader market, which seems to suggest that a hawkish stance is now justified?
Morning, Ira. I think we are in line with what Ashish is mentioning. All these factors have come into play in the last 2 or 3 months, and they are getting manifested in the prices also. I would tend to agree that the policy, we do not expect any kind of a rate hike today, but definitely the stance, the language could point out to all these kind of risks. And market may take some kind of cues from this kind of a policy statement. The other thing which is important today is the markets have actually factored in quite a lot in terms of this, hawkish expectations. So there would be the challenge or key where we'll have to balance it out, because yields have already moved up something like 100 basis points in the last 6 months, and even the short-end yields have started going up. The derivatives curve is pointing out to something like 2 rate hikes in the next in this current year. So all these things now, how much does it fructify, and at what time does it fructify, we need to see. But yes, I think the policy stance or policy, the language is going to be a bit tough on interest rates.
Ashish, you think we could see at least one rate hike this fiscal year or the next fiscal year, that's 2018-19, if not 2, as Manish was pointing out, the derivative markets may be suggesting?
So we have penciled in at least 1 rate hike during the year. We think there is a small probability of a second rate hike, but at this point in time we are saying it will be a 1 rate hike. I think obviously everything will depend on numbers, especially inflation numbers, as they pan out.
So you don't think that inflation will come off once the base effect, and Ashish, I'll just stay with you, once the base effect plays itself out? Your house call is that there will be other pressures which will push up inflation towards, what, 5% or above that?
So the way we are looking at, there is a base effect. We expect inflation to peak around June, July, and then come off. But the average inflation of the year would be around 5%. So while there would be the numbers in year-on-year numbers will change depending on the base, but the average inflation is likely to be around 5%. and with upward risk. So we don't see why, we think there is a good chance of one rate hike at least.
So Manish, we were having this debate the other day, just with internally, so the target is of course 4% plus minus 2%. Is the market now fairly clear that they're going to target the midpoint? I think the debate was that, maybe they could look through some pressures that may be emerging on the fiscal side because it's, linked to structural reforms. Maybe they'll be forgiving of, an inflation range between 4 to 5% and not try and target 4%. But the flip side to that was that, they've just gotten into this inflation targeting framework. If they don't even achieve 4% in a durable manner now, then what is the credibility of the framework?
No, absolutely fine what you're saying. You're raising a very pertinent point here because the MPC's first test is going to be there in April policy, not today, I would say, because till now the inflation target has been between 420 to 470, or the range is 430 to 480. If theoretically what is being anticipated, if the overall target is moved from this range to 480 to 5.5 for the next 6 months, whether the MPC would wait to see a 6% number before hiking rates, or they would hike rates beforehand so that they can curtail it to 4%. Frankly, it's an uncharted territory for markets and for this new dispensation in form of the MPC at RBI. But I personally expect that if the inflation range is going to, move from 430, 480 to say 485.5, then definitely RBI will have to change its stance somewhere in terms of liquidity or in terms of the rates. Coincidentally, in the last 6 months, the kind of moves which have happened in the money markets, starting from the short end to the long end, and also, because of a lot of other factors, we have seen the impact already quite a lot in the markets. Now, whether RBI would follow it up with actually rate hikes or change the stance as and when necessary, I personally feel that if the inflation target is going to move to a higher range, you might see some action from RBI. And one thing I would like to point out here is that, there is, I know the market is divided at this moment, and there are some houses calling for that we have overdone and because of extraneous factors and whatnot. But these are longer cycles. Interest rate cycles don't move, in 1 month, 2 month, or 3 month, or a 6 month. We have come down from a repo rate of 8% to 6%. If we all agree that, we have reached the bottom of the interest rate cycle because of all the factors of Fed and the way Eurozone, we have been hearing the comments from ECB that there may not be any further need for this kind of accommodative stance and whatnot. So if everything changes and the interest rate cycle moves, then it doesn't stop at one rate hike. So, this jury is still out. I'm not suggesting that April rate hike will happen and then next June or whatever. But if the rate cycle turns around, then it won't stop at one rate hike itself. Then it will move by at least 4 rate hikes to adjust to something like 7%. But that may not happen now. That may happen, 6 months down the line, 1 year down the line, I don't know. But these are long cycles. So if the cycle is going to reverse, then don't expect that it will stop at one rate hike.
No, Ashish, come in on that. It's an interesting debate. I know slightly theoretical, not the immediate decision related, but it is an interesting debate as to what this next rate cycle will look like, right? Given the inflation targeting framework in which we now operate.
So, my view on this is, this is a new framework. Yes, we need to see how they will proceed on this framework. But, however, one thing is reasonably clear. All central banks and all monetary policy committees like to have their credibility in place. If they have been given an inflation targeting mandate, they need to be seen to, act so that that mandate is what they are targeting. So I think, yes, there will be rate hikes, but I'm not sure whether there will be a cycle, because, while we have seen cycles in the past, the overall world scenario, global scenario has changed so much. We were, some time back we were fighting deflation, and now, of course, we are seeing signs of inflation. However, even in the US, the rate cycle is very, gradual, and even the terminal rates are significantly lower than what they would have been in the past. So we could see hikes, but we could see, I would put it that way, that we would see hikes, but you would see long pauses between hikes. I don't think I expect a rate hiking cycle in that sense of the word.
Just bringing the attention back to what the markets are worried about. Ashish, staying with you on this one. On the liquidity side, is the market expecting any comfort from the RBI or the MPC statement this time around? I point to the fact that at the last press conference, Urjit Patel said that, look, call money markets rate are near the repo at 6%, so there's no liquidity problem as he sees it.
So if you look at the primary liquidity, there is no problem. You have liquidity surplus today would be around 30,000-40,000. That is more in line with the neutral liquidity stance which RBI has spelled out. The overnight rates are where they are, so and they are close to the policy rate. So there nothing needs to be done on the liquidity per se on the primary liquidity side. However, if you look at the bank's balance sheets, what has happened is you had an increase in the LCR requirement from January 1, increased by 10%. In India, we have this, we have an SLR requirement also, and we have an LCR. In the past, RBI has allowed some leeway where part of the mandated SLR could be used to, reckon against your LCR requirements. But they have not done anything this time. So effectively, what it has done to the system, it is actually increased the reserve requirements from Jan 1, effectively. That has nothing to do with the primary liquidity. So we don't know whether is that a deliberate step, or they were waiting to see how things pan out and they would give some relief in this policy. Very difficult to call on that, but the stated objective of the RBI is that eventually you should not be having two kind of reserves, an SLR as well as LCR. If globally everyone is moving to LCR, we would need to move to only LCR at some point in time in the future.
Manish, do you think they'll tackle that issue that Ashish is flagging off? If so, how?
In terms of liquidity, yes, I would tend to agree that liquidity has tightened. In fact, I would use the word the financial conditions in India have actually tightened over the last 6 months. If you look at the incremental credit deposit ratio, which is hovering around 1.4, and the amount of money which was going in reverse repos have drastically reduced, we have nearly reached a neutrality kind of a stage, though RBI didn't agree at the last meeting on the same, but it's the surplus of plus minus 1% of NDTL what we talk about, which is around 1 lakh crore borrowing or 1 lakh crore lending by the banking system to RBI or borrowing from RBI. I don't see any kind of a step coming in that regard from RBI today. I think, yes, this is a very, very important issue now at the moment with banks, that with the new LCR norms coming up and we are headed towards a 90% requirement, and with SLR continuously being reduced, how much of excess SLR would the banking system require to hold? And that would be determining the overall liquidity scenario in the money markets itself. I still feel that by design or by stealth, if you look at, they have already adjusted the liquidity in the system. It has also been on account of the remonetization of the system. What you look at, the currency which was deposited in the banking system 1 year, 3 months back is now fully back with the system itself. So it is speaking for itself. I think we have reached a stage wherein we are on a neutral kind of a stage. It will depend on what kind of stance RBI takes from here onwards in the next 6 months, and that would determine the liquidity stance also. So basically what I'm trying to say is that if we expect a harsh stance in the sense in form of for rates or for inflation today, then don't expect any kind of a liquidity measure which would alleviate this. We might stay with this kind of a thing and see the final move in April.
Okay, Manish, good morning, Neeraj here. Certain quarters of the market were hoping, if not believing, that maybe the budget could do something to bring the bond yields to a more reasonable level, because the bond markets, probably in India as in the US, are leading what the rate decisions could be. Now, is there anything that the RBI will do, not necessarily needs to do, but will do over the course of this policy or the next, which may calm the markets down a bit? Because as of now, from whatever little we are hearing, the tone will be hawkish. And I heard Ashish mention as well that there's an outside chance of another rate hike coming in this the next financial year as well, something that the markets are probably not prepared for.
Yeah, Neeraj, this has been the debate in markets today. The yields have blown up around 100 basis points in the last 6 months. And that's a cause of worry for the overall financial system also. The kind of AFS portfolio hits which the banking system is taking is also pretty large. But frankly, I do not have any answer to this, what can actually be done. We all know what measures can be done. But whether RBI would take them or not, it's a million-dollar question. Today, we would come to know. Looking at last 6 months, it seems that RBI may not oblige on those fronts in the near future. Because if their stance is going to be moving from neutral to, say, hawkish or, say, tightening mode, or even if they stay neutral with this kind of a bias, why do you expect RBI to come into this? There are some other technical factors also which have played a role in this kind of a thing. You know, if the SLR is going to be, requirement is 19.5% and the banking system is holding around 29.5 or 30%, 10% excess SLR, there is definitely no fresh requirement. And also in conjunction with liquidity getting tighter, the reasons to deploy that surplus is also becoming, it's not required. Plus, I think what we forget is, even though the budget talks about only 3.3% and the government borrowing, frankly, on central government borrowings have remained more or less stable for the last 2.5 years, it is the state government borrowing which has hit the system quite badly, because they were borrowing only something like 1.5 to 1,75,000 crores 2 years back. This year, the gross borrowing of states is around 4,25,000, which counts for SLR, which satiates the demand for insurance companies and provident funds. So, from an overall borrowing of something like 8 lakh crore, we are going to be something like 11.5 lakh crores, including state government and central government. So this shift of borrowings has moved towards state governments and the way it is being managed between the center and state. Net, where I'm coming from is the supply has been higher for the system. And this year, coincidentally, if you look at, I think Ashish would corroborate that, the deposits are not growing at that pace.
Yeah.
And the credit has actually grown. So it's a combination of all these things which are leading to this kind of a thing. Yes, the usual suspects are there. People have been talking about OMO. People have been talking about, you know, some kind of switches being done by RBI. But that, I would say, we'll have to wait and watch what RBI does today. Besides the normal switches or the buybacks, which the central government is, you know, they have put it in the budget. Right. But beyond that, I am doubtful that you're going to see anything from RBI today.
Okay. Ashish, could they generate some additional demand by raising FPI limits, or at least guiding towards an eventual increase in FPI limits, both for government bonds and for corporate bonds? And isn't the previous, 5% of government securities, that was March 18, right? So anyway, they are due to review their FPI limits for government bonds, Ashish?
Yeah, they are due to review during this quarter. I think, there is, now again, there will be a debate whether it makes sense to do it. Will it cause an issue in the future whenever they come to sell? But however, as Manish pointed out, just the supply between the government of India and state government is so large that it more than satisfies any need of domestic investors. And what especially the state government supply is doing, you have the longer tenor investors such as insurance companies and provident fund. You get reasonably very good yields on the sovereign paper, as sovereign as you can get other than government of India. So what it does is, their preference moves to obviously to state loans rather than government of India or even corporate bonds. So actually the state government of state loans are actually crowding out both the sides. It is crowding out the government of India supply, it's also crowding out the corporate bonds. So if that is the case, and that's reality, you would need a new set, you need more investors, and you would, I think, from a pure demand supply need, you do need increase in FPI limits both for government bonds as well as for corporate debt.
Yeah, the only problem there is the global backdrop, I guess. I have time for one last question each, so I'm going to put you both on the spot. Ashish, staying with you, what scenarios would the market react to? If it's a standard, slightly hawkish sounding stance, no change, market is more or less stable, but if you get, I don't know, some indication of an actual probability of a rate hike in the next few months, there will be a negative reaction and a positive reaction if the FPI limits get hiked?
So I guess the positive reaction would come only if something like an FPI limit gets hiked. Otherwise, I would expect the market to be here or react slightly negative to whatever comes out of the policy.
Manish, same question to you. And where are you penciling in 10-year yields now?
I think 10-year yields are hovering around 7.5 for currently. They should be around similar levels. I think maybe 5-10 basis points here or there. I hope and I believe that we are nearing the end of the cycle in terms of, at least for this quarter, the yields, they have gone up so much. But on FPI limits, I think we would not come to know before March end or April, because it's a big review in terms of how much foreigners should be owning our government bonds and how much do they want to open. So that I have my doubts that today they would be coming up with this resolution. That would take some time. But yes, I think if the markets, if RBI comes with a real hawkish tone, and frankly, the key thing what markets are looking at is how do the members vote today, which one member has been talking about a rate hike for last 2 or 3 policies. One member has been talking about a rate cut. How does that stack up today, and what do the other members do in the backdrop of what's going on, higher inflation, the fiscal deficit not being met, and the next year's fiscal deficit target a bit higher, inflation higher, and the kind of reaction which is happening worldwide. So if any negative commentary comes from that point and the voting pattern changes, that would be watched very, very carefully, because that would give a signal for future in terms of what is in store for April. So all these factors, I hope today we have a stable day. That is what I can just at best say.
All right, both of you have a great day, and yes, we'll watch to see whether we have a 3-way split in the voting pattern, 1 rate hike, 1 rate cut, and then the rest of them no rate changes. Thank you both so much. Really appreciate you taking the time, Ashish, Manish, for joining us on this chat.
I doubt that today there would be a rate cut.
Yeah, so but I was saying 3-way rating, 3-way split on the voting pattern. One person, Michael Patra, saying rate hike, Dholakia saying rate cut, and then the rest saying steady. That would be a fun policy to report on, is all I'm saying.
Well, that's why I'm saying I doubt that anybody would be batting for a rate cut today.
Okay, got that. Manish, Ashish, thank you so much. Really enjoyed chatting with you this morning. All right, I think that's the full setup for the Monetary Policy Day. 2:30 is the decision.
Yeah, and looking forward to hearing Ida from the RBI headquarters as well. By the way, just before we wrap the show and give it over the FNO show, must mark, maybe the markets are nervous about the policy or otherwise, I don't know what. But we're off from the highs of the day quite convincingly, just about 0.5%. The Nifty banked to just about 0.5% in trade. So no great moves there, but for the oil marketing companies which are really doing well. Aside of that, it's a bit of a quiet market. Wrap it up on this leg of Indian Open. FNO show takes forward the action on the other side.